Now let's have a look at the S&P 500 forward spreadsheet. This allows us to have a look at what our investments might be like as we would actually experience them, starting with some invested amount, say $50,000 in 1989 and going on for, say, 36 years. Let's have a look at the plot. Click on the plot tab, and we see that when not reinvesting the dividends, you'd follow the red line, and when reinvesting the dividends, you would follow the blue line throughout this investing timeline. This is actually what you would experience had you started in 1989 and bought a fund that followed the S&P 500 when, again, reinvesting your dividends along the blue line. The dashed line, that's the model best fit to the data. And same thing with this red dashed line down there. Those models are adjusted based on these annual percentage gains. And so when we go back over here, we see that there are times when we are below the model, below expectations, and times when we're above the model and therefore above expectations. And you might say, I would be happy at some times and sad at other times. So this is how I created figure 13.1 as well as many of the other figures you see in the book, where we're looking at a timeline of investing with some given starting lump sum amount. And so we can change this. Instead of starting in, by the way, let's go back to the plot, and you see that we ended up with about $2 million, which would be very nice to have after having started with $50,000. Let's instead start with our $50,000 allocation, but instead start in, say, 1970 and invest for 35 years and therefore end in the year 2005. We can scroll down here to the bottom of the plot and see, well, we can't see the numbers here, but I'll show you how much money we would have had we done that investing. Well, now you see the plot's kind of convoluted here. We need to expand this y-axis, or rather this x-axis. So right-click on the tab, unprotect the sheet, double-click the x-axis, enter 1970 to start, and 2005 for our ending point. Now this is real, and then you can click this little X to get rid of it. Now this is very interesting. Here we're generally below expectations for a while, and then we're really rocketing up above expectations as we go through the go-go 90s. And then all of a sudden, man, things get really bad as we start the lost decade in through here. But at least we didn't drop below our expectations and then we take off again. In other words, as we approach retirement, this would be really some heart-stopping, heart-wrenching experiences for us. We'd go from a high of around 2.3, 2.4 million down to a value of less than 1.5 million, losing close to $1 million just as we're approaching retirement would have been really heart-wrenching and difficult. But then we might get excited because, well, it's coming back. Okay, but let's see what happens if instead we had, instead of starting in 1970, we had started in 1975 and therefore ended in 2010. What would our life have been like then? Well, now we got to change the x-axis again. So it started in 1975, and now we're going to end in 2010 and click the X. Wow. This would have been really challenging time to have been an investor. As we saw the rapid increase in our $50,000, we would have been very excited at 2.5 million. Then we would have been sad. Then we would have been happy. But look what really happened here. This was the Great Recession. We'd have had close to $3 million, $2.9 million, and then dropped all the way down to $1.5 million. As the markets were collapsing in this very short period of time, about a year to a year and a half worth of time, this would have been heart-wrenching as an investor. You would have been so tempted just to sell everything and just get out. And then what would have happened here? You would have lost out on this increase over here. This is why our bonds become very important, because there's a lot of volatility in equities, less so in bonds. So I encourage you to adjust those starting points, adjust these investment values that you see in through here. There's only really three parameters you need to invest or adjust. And then as you adjust that, don't just look at where you end. Look at how you would have felt along the timeline, realizing that you don't know the future at any point in time along this line. You don't know what's going to happen in the future. So you have to be prepared for this emotion that you're going to go through.